I extend a very warm welcome to all who are joining this webinar today on retirement planning. This is the second session of a three-part webinar series on retirement planning. On behalf of the Director General, Human Resources, Ministry of the Public Service, and the Director, Learning and Development Directorate, welcome, and welcome. My name is Sheila Grisette, Senior Human Resource Officer acting at the Learning and Development Directorate. I will be your moderator for today's session. My colleague is Fayan Jordan, Human Resource Officer, also with the Learning and Development Directorate, is the co-host for today's presentation. As we commence this morning's presentation, there are some rules of engagement I wish to share with you. As much as is possible, please pause or minimize distractions. We want you to benefit fully from the presentation. As the facilitator goes through the presentation, take some time to reflect on relevant issues you may wish to share. We want to hear any comments or observations you may have and answer any questions or queries you may wish to pose. Please note that a question and answer segment is included at the end of today's presentation. You are invited to share your comments, questions, queries, or observations throughout the presentation by using the Q&A icon at the bottom of your screen. Your contributions will be shared with the facilitator during the question and answer segment, who will then respond via audio. Please note also that today's session is being recorded. The recording will be posted to the Learning and Development Directorate's YouTube channel. A message will be sent via email blast to alert you when it is available for viewing. Ladies and gentlemen, please join me in warmly welcoming our presenter for today, Mrs. Gail Worrell. Gail Worrell is a seasoned professional financial advisor with a diverse skill set and a commitment to helping individuals and businesses achieve their financial objectives. With half a decade of comprehensive experience in the field, she's established herself as a trusted advisor in retirement planning, money management, risk management, and budgeting. She takes a holistic approach to financial planning, considering both short-term needs and long-term objectives to formulate comprehensive strategies that drive sustainable goals and prosperity. With a clientele of approximately 275 individuals and businesses, Gail has demonstrated her ability to cultivate lasting relationships built on trust, integrity, and genuine commitment to her clients' success. Whether guiding individuals towards goal achievement or retirement planning, assisting families with estate planning, or supporting businesses in achieving their financial goals, Gail provides personalized solutions that align with her clients' unique circumstances and aspirations. Outside of her professional endeavors, Gail enjoys volunteering her time to promote financial literacy initiatives and empower individuals to make informed decisions about their finances. She firmly believes in the transformative power of education and strives to empower her clients with the knowledge and resources they need to navigate the complexities of the financial landscape with confidence and clarity. Gail, good morning and welcome. And I'll hand over to you and invite you to begin today's presentation.
Sheila, thank you so very much for that warm welcome and good morning to each and every one of you. Thank you so much for being here, joining the call on retirement planning. As Sheila mentioned at the beginning, this is the second part of a three-part series entitled Retirement Planning Talks. And today we are going to be covering a number of topics, which include investments. We're going to be discussing Social Security as well as financial readiness for health and long-term care as it relates to retirement. The objectives of today's webinar is to help you to focus on the critical aspects of retirement planning. And so the 4 major factors that we will be discussing today are those that are shown on your screen. We will be examining the basics of investing, identifying investment strategies, understanding Social Security income benefits, as well as assessing financial readiness for health and long-term care, so that by the end of today's webinar, you should have a clearer picture of what you would need to do to achieve your retirement goals, your retirement objectives. All right. So the first factor we will be examining today is the basics of investing. And we do want to start out by understanding the components of investing and why it is important to start as early as possible or from as young as possible. So the first factor in investing or considering investing for retirement planning is compound interest. So the earlier you start investing, the more time your money has to grow. Yeah, so compounding allows your investment earnings to generate their own earnings, which significantly increases your retirement fund over time. The second factor is managing risk. So starting early allows you to take advantage of riskier or higher yield investments when you have time to recover from any potential losses. So that as you approach retirement, you can shift to safer investments or investments with lower risk or loss tolerance. And then the third and most important factor is financial discipline. The importance of starting early in investing cultivates the financial discipline and habit of saving, and therefore reducing the temptation to spend unnecessarily. So imagine you're planting a tree in your backyard with the goal of, growing a sturdy and fruitful tree. All right, the initial planting, which when you first start planting that sapling, which would be considered as your initial investment, it starts small. Now you water it regularly, which will be considered as your initial contributions. You start to take care of it. You make sure it gets enough sunlight, enough market exposure, so that it begins to then grow over time. And as time goes on and the tree grows, there are small buds that start to appear. Then they turn into flowers, and then they turn into fruits, which is, in investment terms, your return on investment, or your investment returns, right? So each year the tree produces more fruit than the previous year because it's growing stronger, it's growing larger, etc., which is considered as your compounding interest. All right. Now, financial discipline, you want to think of discipline in maintaining the tree, right? You need to prune it regularly. You need to have your consistent contributions, protect it from pests, protect it from any, unnecessary risk, if I may put it that way. All right, which could be tied to avoiding unnecessary spending. But if you neglect it, it wouldn't grow, right? If you are disciplined, the tree will flourish. And then from a risk management perspective, what happens if a storm comes? We were able to witness over the last couple of days what the impacts of a storm could be. So you want to protect your tree. You want to build a fence around it. You want to take care of it. You want to make sure that, in investment terms, you diversify and you invest in certain strategies to make sure that whether a storm comes or not, that your tree can remain as strong and as resilient as possible. Now, the fence that you may put around your tree, it doesn't prevent all damage, but it reduces the impact. So you have to then have an emergency plan. right? That's like keeping some resources aside to take care of any damages, having emergency savings, or having risk mitigation strategies to ensure that all is not lost, regardless of the storms that may come against your tree, against your investments. All right, so the long-term rewards here for starting early over the years, you know, your tree becomes robust, it yields the fruit that you would have initially imagined. And because you started early and manage your risk properly, manage your investments properly, you then have a bountiful harvest or a significant retirement fund at retirement age. All right, so that even if the storms do come, your tree or your investment is strong enough to recover. And that's thanks to carefully nurturing and preparing that tree or your investment fund for as long as possible. All right, so in summary here, component interest works like growing a tree. You're consistent, you're careful, you have protection against the risk. Your initial investments multiply over time, resulting in a resilient asset. Now, on the flip side, we will understand that there are consequences of not investing early or not taking care of that tree from inception. Now, without your retirement savings, it might lead to a number of things. One is insufficient retirement funds, leading to financial stress and other factors in your later years. Because what we understand is that Social Security and having one stream of income at retirement may not cover all of your expenses and financial obligations on a month-to-month basis. Now, you could also come up on a reduced quality lifestyle where you lack sufficient funds. Your lifestyle choices then are limited. The things that you've wanted to do or foresee doing during retirement, because you have more time on your side now, more time maybe during the day, things like traveling, taking care of your health, other desired activities in retirement are hampered because of having insufficient funds. And then increased dependence. So without a solid retirement fund or multiple streams of income coming back into you, you may then have to rely on family. You may have to rely on friends, social programs, or potentially compromising your independence, putting a strain then on relationships, right? So these are things that we want to avoid by starting early. And then you have your missed growth opportunities. Not investing means missing out on potential growth from stock market, from other investment opportunities, which could have significantly increased your retirement savings. So you want to take a look at this now from a planning perspective, right? Where imagine you are planning a long road trip across the island with your final destination being somewhere beautiful, a remote location. Let's say, for example, Bathsheba. All right, you want to be able to go there sometimes and spend your golden days, spend your golden years with a friend, by yourself, with family members, with grandchildren, etc. Now, here's how not starting to invest for retirement in the early could impact your journey. So you end up with insufficient funds, right? So this is like running out of fuel. Yeah. If you don't start saving and investing early, it's like setting out on that journey to retirement without enough fuel in the tank or money for gas along the way. And as you travel, you might find yourself running out of fuel far from a gas station, forcing you then to stop and wait for help. Anybody ever had that experience? I certainly have. All right. It disrupts your trip and it can possibly leave you stranded. You don't want to be in a situation of feeling stranded financially at retirement. Your reduced lifestyle now comes where, for example, you're driving an unreliable vehicle. And by not investing early, you're essentially choosing to make this long journey in an old or unreliable vehicle quite challenging. You may have to deal with frequent breakdowns. You can't enjoy the comfort and the safety of a well-maintained vehicle. And this means then that your journey will be less pleasant. You might have to forego visiting, scenic areas along your tour or your drive, right? Or you may have to take scenic detours because your vehicle, your retirement fund, cannot handle it. Increased dependence now, again, if you're looking at it from a picture's point of view, is like hitchhiking. So if your funds run out because you didn't invest earlier, because you didn't plan from in the early, you find yourself then needing to rely on others to get you to your destination. And much like having to hitchhike when your car breaks down, this makes being dependent on others who may be then strapped for cash, their generosity, and you relying on their schedules or the freedom of others to control your journey. Right? The missed growth opportunities now is like skipping those scenic routes altogether. So investing early is like choosing the scenic route with opportunities for beautiful views and memorable stops. But not investing early is like taking the shortest, most monotonous route because you did not plan well. You miss out on all the amazing experiences, growth opportunities along the way, making your journey less enriching and less fulfilling. And these are experiences that you want to be able to enjoy throughout your retirement journey. So by starting your investment journey early, you ensure you have enough fuel. You ensure that you have a reliable vehicle to drive. You're then able to maintain your independence and fully enjoy all of the scenic routes and growth opportunities along the way to your retirement. Now you may be asking yourself, is it too late? How do I get started? What does it look like from here? How do I move forward? And the first thing you want to do is to educate yourself. And that's why you join today's session. You join today's session because you're eager to find out what does planning for retirement look like for me realistically. All right. So whether that's investing in books, whether that's investing in online courses, whether that's speaking with an advisor, whether that is speaking with a friend who may have, been able to tell you, hey, put aside a little something now. The financial discipline of doing that will reap the rewards in the long run. You may feel a little uncomfortable from the get-go, but it helps in the long term. Right? You want to be able to educate yourself. Speak to those who are currently retiring. Speak to those who may not have been financially disciplined from 20, 30 years ago and see what they're experiencing now and maybe learn from their experiences. Maybe you want to speak with someone who has been able to put aside something from 20, 30 years ago, see how they did it. All right? You want to set clear goals. You want to define what your retirement goals look like. And you also want to take a look at your age so that you're able to have a timeline and know what you are working towards. Be able to identify what your lifestyle will be during retirement so that you know what lifestyle you have to maintain. All right, you want to develop a plan. You want to develop a retirement plan that includes regular contributions. You want to look at diversifying your portfolio to make sure that your investments are not, as the term goes, having all your eggs in one basket. You want to also take a look at that plan or those plans or those diversified investments regularly. You want to have periodic reviews and then adjust the strategies as necessary. Those are the factors that are created or cemented into creating a plan. Yeah. You want to also take a look at setting up an automated savings, or we were referring to earlier as an emergency fund, to ensure that your retirement account or your retirement plans are not jeopardized because a storm may come your way. You want to make sure that they can be invested in or contributed to often. All right, without having the temptation or without the temptation to spend. Right? And we want to monitor and adjust those investments and those plans and those strategies very often. If that's not once a month, once a quarter, it should at least be once every 6 months, and definitely more often than once per year. All right. Now, the next thing we are going to do is poll. We would have had some polls in the previous session, episode 1. This is now episode 2, and this is our first poll for today. And so you will see a screen pop up on your screen asking the first question of at what age do you, or at what age, sorry, did you or do you plan to start investing for retirement? You can select the drop down box, and there are 6 answers there for you to choose from. If you have started investing, what age did you start at? If you have not started investing, what age do you plan to start investing for retirement? Now, as the results come in, you're not going to be able to see who would have selected what, but what this will show us is that you are in the same category as someone else, which means you have company. You either have work to do, you may have started already, you may not have started as yet, but you have some company. All right, because the next thing we're going to get into is investment strategies per age range. All right, when you're finished, you hit submit, and then we will pull up the results on the screen. It's going to give you a couple more seconds to complete those, and then we will take a look at the results. All right. So this is very interesting. This is interesting because, as you can see, each category has an answer. So if you did start to invest and you started investing from the time you were under age 25, kudos to you. It means that you have started and there is a vision. The majority of you selected between age 25 and age 34. Right? 12% of you have not started as yet. And as you can see, you have company. You have persons in your portfolio, in your category who have not started as yet. For those who would have started 55 and older, you know, there may have been some things that you would have had to change. There were some strategies that you may have had to implement to make sure that there is still something or something can still be built for you by the time you reach the age of retirement. All right, so this is great information. So let's move on now to the age group strategies. Now, for those of you on the call who are in your 20s to 30s, the good thing about this particular age group is that you have time on your side. And this could be considered as a good thing, or this can be considered as a bad thing. But today, it is a good thing. Time is on your side, which means that the earlier you start, the more time your investments have to grow through compounding or through whichever investment strategy you decide to invest in. All right? So by starting early, you have an advantage. All right? The second thing is being able to tolerate certain risk. Now, you can afford to take more risk since you have more time to recover from any potential losses. Because as you can imagine, investments do have their advantages and disadvantages. We will get into that a little bit further in the presentation. There's a certain level of focus here as well, because growth-oriented investments like stocks and mutual funds, etc., call for a little bit more focus and call for a little bit more financial discipline as well. All right. The next one is diversification. So you want to take a look at what your risk tolerance looks like. And then you also want to consider how to invest your funds or your savings or your disposable income so that it works for you and those earnings begin to grow their own earnings, which then start to build your retirement fund from as early as possible. So for the young adults here on the call today, it's like planting a seed. It requires some time, it requires some patience to build or grow a very strong tree. Yeah? So for those now in their 40s and 50s, the first thing we want to take a look at is you have a balanced approach, because start to balance between growth and security. So your risk tolerance levels may not be as high, but you want to start to then take a look at investments that can reduce higher risk investments as retirement may be closer for you. All right, so you want to adjust as you go along. Diversification, you want to continue to diversify to protect against market volatility. So for middle-aged adults, this is like pruning the tree. All right, you want to clip off any dead leaves. You want to take a look at ensuring that it grows healthy, that it continues to grow strong. If it starts to veer too much to the left because of windy conditions, you want to be able to put a stake in and make sure that it comes back to grow strong and upright. All right, you want to make sure that it is well protected, that it is functional, and that your returns on investments can reap the rewards when you do get to retirement age. And then for those in your 60s, you want to focus majorly on preserving your wealth rather than looking at aggressive growth for investments. Now, your income producing investments, things like bonds and dividend paying stocks and real estate, etc., those things are where you're looking, those things are the things that you're looking to preserve. So if in the example of real estate, you want to make sure that your property, right, is preserved. You want to make sure that your estate is preserved so that your income, the income from that real estate or from that property, can continue to grow. Right? So this is now like enjoying the fruit and enjoying the shade from that tree, where you then focus on maintaining it. And the risk here are as low as possible. You want to make sure that they shift towards lower risk in that type of investment, or whatever investment tools you are looking at, ensure there is stability. All right. Now, Benjamin Franklin said, an investment in knowledge pays the best interest. And I thought this quote was rather profound, because generally persons may say, well, I have to be a know-it-all before I start to invest. I have to know when the right time is going to be. I have to know what the market conditions were before in the last 10 years before I can dictate whether I will invest in a particular tool or have a particular strategy. Or I have to be able to know all about stocks and all about bonds and all about real estate and all about trust and all about certain accounts and savings and this bank and the other financial institution before I start to invest. right? An investment in knowledge pays the best interest. It means that you have to have a little knowledge before you can start to invest. It doesn't mean that you have to be a know-it-all. You do not have to be the guru in a particular area before you start to invest, because what does that do? It cuts down on time. All right, it cuts down on time. It cuts down on time, maybe sometimes years, that you could have started in one particular area or another. Now, the second factor we will review today is identifying investment strategies. All right, now there are 5 common investment strategies that can benefit retirees by providing regular cash flow. Now, each strategy has its pros and has its cons, and we are going to be going through those right now. So the first one is dividend-paying stocks. Right? The pros in the dividend-paying stocks is that it has regular income from those dividends, potential capital appreciation, and potential tax advantages as well on qualified dividends. The cons or the disadvantages here is that dividend payments are typically or usually sometimes not guaranteed. All right, stock prices can be volatile and companies can reduce or eliminate dividends through tough times. So you think of dividend-paying stocks as owning a rental property, for example. And just like a landlord receives rent payments from tenants, stockholders receive dividends from companies. However, if the property market crashes for some reason, the value of the property may decline and tenants could potentially leave. All right, so that's one area or one example of dividend-paying stocks. The second one is bonds. And the advantage of investing in bonds is that there's a predictable income stream. The risk here are generally lower compared to stocks, and the variety of bonds, definitely there's a variety of bonds that are available to invest in. So sometimes you may have government bonds, corporate bonds, there's a bonds plus initiative, etc., that the government would have recently rolled out. Now, the disadvantages of this is that there's a lower potential for high returns. The interest rate could also be a risk, where bond prices may fall when interest rates rise, and the inflation, of course, can erode purchasing power of fixed interest payments. So when we take a look at bonds, bonds are like lending money to a friend in exchange for regular interest payments. So if your friend is reliable, someone that may have a high credit rating, you can expect consistent payments, but the value of those payments might be much less in the future due to inflation. All right. The next one here is real estate investment trust. This is not one that is commonly used here in Barbados, but it is one of the investment strategies that you could look into as well, because they're high dividend yields, diversification, which is exposure to the real estate market without direct property ownership, and liquidity. Right? The advantages here is that the real estate investment trusts are subject to real estate market volatility. Their potential for lower returns during economic downturns, and also things like management fees can eat into profits. All right, so this is more like owning shares in a large apartment complex or a large commercial complex, where you receive a portion of the rental income as dividends without the hassle of being a landlord. Right? However, there are obviously real estate market slumps, and your income could potentially drop. The fourth one is annuities. An annuity, the advantage of an annuity, I should say, is that there's guaranteed income for life depending on the type of annuity. It can provide peace of mind with a steady income stream. All right, and generally annuities are tax-free. They can be complex, right? There's limited liquidity. Inflation can reduce the real value of fixed payments. However, the payments are guaranteed. So annuity now is like you have a pension plan for yourself, which becomes a private pension. It has nothing to do with government pension. All right, so this is where you may give an insurance company a lump sum of funds, and they promise to pay you regular income in the form of a pension. So it is reliable, but it is not flexible. All right, and then you have preferred stocks. Higher dividend yields compared to common stocks, priority over common stocks in dividend payments, less volatile than common stocks, limited capital appreciation potential, dividends can of course be suspended, interest rate is very sensitive. So preferred stocks are like having a VIP pass at a concert where you have, certain privileges, but your experience is less dynamic compared to general admission, where it's a little bit more excitement in the crowd. All right. Now, overall, when you take a look at investment strategies, they can generally be tailored to fit an individual's risk tolerance. They're tailored to fit in your investment goals, your retirement timelines, and they provide diverse options for generating cash flow during retirement. All right. So the advantages overall, there's growth potential, opportunity to grow your wealth significantly. There's income streams, providing additional income through dividends, interest, and capital gains. Diversification reduces risk by spreading the investments across your portfolio. And then there's financial security, which obviously helps with being financially stable in the future. Now, as I said before, there's advantages and there's disadvantages of investing, like everything else. All right. So there's a risk of loss. Investments can decrease in value, leading to potential losses. Market volatility. Market conditions can fluctuate and can affect investment values. And that can happen across the board. All right. The fact that we require knowledge. Successful investing requires understanding the market and various assets. And like I said before, you don't have to be a guru before you start to invest. All right. There is time, there is patience that is necessary in terms of allowing the investments time to grow. All right, because it is a long-term commitment. Or generally, when persons come to investments, when it comes to investments, everybody wants to put in today, get out tomorrow. But investments, particularly towards retirement, requires patience. It requires long-term commitment. It requires financial discipline. It also requires making sure that you are adjusting and reviewing your portfolio as often as possible. All right. Now, the third area we're looking at this morning is understanding Social Security. Now, for some of you, there may be information that is publicly known. All right. This information that would have been prepared for today's presentation was found and sourced from the National Insurance and Social Security's webpage, along with obviously my own personal research. Now, there is information that I will share with the host and co-host of today's presentation, which can be shared with you, which involves information directly from the NAS website, as well as information that can gain access, which is a form, to access the NAS online portal. I'm not sure how many of you on the call would have known that NAS has a portal, but there is an online portal where you can sign up and you can log in to make sure that your information is correct, to make sure that your information is up to date, to check and make sure that from the very first time you had a job and you were able to get your NAS number, that all of your previous contributions were and have been submitted and recorded. All right, now we will discuss a little bit more about that in a couple of slides, but what we want to look at this morning briefly is the benefits that are offered by National Insurance and Social Security Service. Now, there are short-term benefits and there are long-term benefits. Now, subject to correction, it is my personal understanding that for short-term benefits and long-term benefits, there are qualifying factors. So, for example, someone who is not currently or has never contributed to National Insurance and Social Security Service would not be eligible for things like sickness benefits and unemployment and employment injury benefits. All right. However, with that being said, there are qualifying factors for employment injury. So, for example, those who may be self-employed and who do not contribute to this particular fund, and similarly with unemployment benefits and severance, etc., obviously would not be able to benefit from the same fund. All right. Now, a few items to note here. Invalidity pension for those individuals who or babies, let's say, for example, who were born to a contributing parent, right? The baby now may have been born with lifetime birth defects. All right. That particular fund would pay, or that parent then would benefit from having those benefits paid as an invalidity pension or grant, depending on how many contributions have been paid into NAS from that parent. All right, disablement pension is paid to an individual who has more than 50 contributions or 1 year's worth of contributions to NAS and has become disabled due to an accident, due to an injury or illness, and can no longer work. Death benefit, for example, as you can see, death benefit, there is what we refer to as the funeral grant. I think that's a little further down. There is a one-time payment, right? That one-time payment as a grant is $2,250, which is increased from $65, which is an increased salary of $65 from last year. Last year's amount was $2,185, and we've had some changes as of January 1st, 2024, which takes care, obviously, of a fraction of today's funeral costs. However, it is something. All right. And then you have things like your survivor's pension, right? Where this is now something that is paid, or a benefit that is paid to the spouse of a deceased as a pension for a period of time or until that spouse cohabitates or remarries. But what we are more interested in today is old age contributory pension. Well, there are a few points to note here. And as I said before, this is public information. To be eligible for old age pension, an individual must have at least 500 contributions submitted to NAS. Now, there are some changes that are currently being made where that 500 contributions will move from 500 to 750. It is therefore important to note that having access to the NAS portal should be a priority to ensure that all of your contributions are paid in from as early as your very first job. Because if you have 498 out of those 500 contributions, you may be forced to work for an additional period of time to ensure you qualify for old age contributory pension. All right. Now, as you're aware, the current pensionable age is 67. The proposed changes of the age increasing from 67 to 67.5 in 2026, and from 67.5 to 68 in 2028. Now, if an individual opts to retire prior to their pensionable age of 67, they stand to lose 6% per year of their pension. So for those of you who may opt to retire at 65, for example, you lose 12% of your pension and it remains at the reduced amount for the rest of your pensionable years. Now, the flip is also true. The opposite is also true for those who opt to defer their pension to after age 67. So, for example, if you opt to retire at age 70, you stand to gain 6% per year for every year after the pensionable age, which is 67. So, for example, if you choose to retire at age 69, you stand then to gain 12%. All right. Early pensionable age is no longer age 55, it is now age 60, and late pensionable age is considered now at age 70. Now, if an individual wants to defer their pension, you must notify NAS well in advance to ensure that the qualifying factors are met and any personal details are updated. So let me give you an example. Something as simple as your name can cause delays in dispersing benefits. Now, this is a real life scenario. Let's say, for example, your name is Robert. Your name is Robert Brown, but everybody calls you Bob. And because you may have been working for a friend, a family member, somebody that's been close to you, and they've been accustomed to calling you Bob for the last 40 years, you are working with them, your pay slips, for example, maybe not as a government employee, but your pay slips, for example, your deductions are being submitted to NAS as Bob Brown. Your contributions are then placed in what they refer to as a clarification file. All right. Now, this clarification file, when you show up, physically show up to NAS to find out, if and why my pension is not paid out or why it's taking so long, they now have to go to that clarification file and have your name changed from Bob to Robert Brown. And that can, as you can imagine, take some time. So it is important for you to have access to your NAS portal where you can go in and check and make sure that all the details on file are correct for you. Now, in order to have a scenario like that rectified, NAS does require for you to show up in person at the NAS office with a copy of your birth certificate and possibly your ID as well. All right, so that's just something to make note of. Now, insurable earnings, or what is considered as insurable earnings, as of January 1st, 2024, your insurable earnings per week are between $91 per week and a maximum earning ceiling of $1,201. So if you are earning more than $1,201 per week, NAS can only take into consideration a maximum of $1,201 as your earnings ceiling. And similarly, per month, your earnings ceiling is $5,200, which means that if you are earning more than $5,200, let's say, for example, you will be earning $8,000 or $10,000 or $12,000, NAS can only consider up to a maximum of $5,200 for your insurable earnings. All right, now what that does is it levels the playing field for everyone so that when it comes to retirement, those who are earning less and those who are earning more stand a better chance of being able to have something, right, a percentage of their income paid to them at retirement. All right, so it is fair. Now, the contribution rate, I'm not sure if you're going to see it very clearly on your screen, but there are contribution rates where you understand how your deductions for NAS are split. All right. So you have your national insurance, your non-contributory fund, unemployment, employment injury, severance, training levy, catastrophe fund, and the health service contribution. Now, as you can see, for the majority of government employees and private sector employees, your deduction percentage is 11.1%. Yeah. So as you can see here, for severance, as an employee, you are not contributing towards that factor. All right. For things like the catastrophe fund, for example, every person contributes 0.1% or 10%, 0.1%, sorry, yes, to the catastrophe fund. So if, for example, when we had the freak storm the other day, when we had certain casualties and so on, the payments from NAS to help those individuals to rebuild their homes, to fix their roofs and stuff like that came from the catastrophe fund. All right. So you're able to see how it is split, how it is separated, so that as an employee and then your employer contributes a little bit more for you in certain categories, and then the total amount is submitted to NAS on your behalf. Okay. Now, the good thing is that NAS has a lot of information available to us. All right, there's a guide which I will share with the host and co-host. The information on this chart is quite small, but this gives you an idea of how to plan for retirement as well, where it includes information on early retirement. It speaks about early retirement and a pension reduction, deferred retirement and pension increase. It also talks about employment and old age pension, and a plan and what the factors and the required documents are that you would need to submit to NAS in order to apply for old age contributory pension. It also speaks about the payment of NAS contributions, the NAS portal, and this is another great feature that the NAS portal has, which is an estimation calculator, which you are able to use to calculate what your pension payments will look like when you retire. And the payment of pension now by direct deposit rather than by check, and therefore it would require your items like your TAMIS number and making sure that you have up-to-date banking details on file so that you get your pension by direct deposit directly into a bank account of your choice, rather than having to wait on a check to maybe come in the mail, or having to collect it and having to stand up in a line for it to be cashed. All right, the benefits of the direct deposit: very fast turnaround time, early payment, no standing in the lines. There is real-time transfers. Your banking details can be updated, things of that nature. NAS provides a lot of information for you. All right. So this information will be shared and then dispersed to you after today's webinar. Then we want to be able to know and understand how to maximize your Social Security. So there are a couple of things that we can do to maximize Social Security. And the first thing comes along with understanding your Social Security benefits. Now, persons may say the longer you work, the higher your Social Security benefits will be. And typically that may be true. However, it all has to do with the number of contributions and the qualifying factors involved in contributing to the NAS fund. So if you have individuals who you know are currently self-employed, they're contracted employees, they are working and they are not contributing to NAS, I would want you to encourage them, right, to contribute to the fund so that you, as well as them, can benefit from Social Security benefits in the future. All right. Delaying your Social Security benefits past your full retirement age, as I would have mentioned before, increases your benefits by about 6% per year until age 68 or age 69. So the options are there. All right. You also want to take a look at calculating your Social Security benefits. As I mentioned, that can be done by the estimation calculator on the NAS portal. The second thing you can do to maximize your Social Security benefits or to build a buffer around your Social Security benefits is to invest or take a look at private pensions. So whether you have a private pension or you're looking at or considering a private pension, whether that's at a bank, an insurance company, a financial institution, that can help to buffer your Social Security and or open and contribute to a traditional savings account that may offer high yielding interest rates, that's something that you can also consider. You want to maybe consider the options and take a look at the tax advantage or tax-free pensions as an alternative to buffer your Social Security as well. You want to diversify your investment strategies. So you want to spread your investments across different asset classes. So like we would have mentioned before in the investments strategies component of today's webinar, things like stocks and bonds and real estate to be able to mitigate those risks as much as possible. And invest with a long-term perspective to benefit from the compounding interest growth as well. Now, financial planning plays a huge role in planning for retirement because it still involves budgeting. It still involves creating a detailed retirement budget to be able to understand what your income needs will be at retirement. All right, building that emergency fund to be able to maintain and cover any emergency expenses. All right, now the next poll we are going to have is to understand how confident you are in understanding how Social Security benefits will impact your retirement income. So you'll see you'll see a screen appear as well on your screen, right? And you do the same thing as before where you click on the drop down and you select one of the 4 answers. So how confident are you in your understanding of how Social Security benefits will impact your retirement income? And once you select your answer, you hit submit. And like before, you're not going to be able to see who would have submitted what, but it will show you who else is sharing your same position. All right, are you very confident, somewhat confident, not very confident, or not confident at all? And then we're going to go ahead and share those results on the screen so that we can see how confident you are in your understanding of Social Security benefits. Okay. All right, so we are mostly somewhat comfortable in your understanding of Social Security benefits. All right, so 48% of you said somewhat confident. 38% of you said not very confident, which means that there is some homework to be done. All right, now the form that it will share with you will definitely give you an understanding once you're able to access the NAS portal. And we want to encourage you to plan as best as possible for retirement by taking a look at your overall budget, taking a look at what your financial obligations will be after you retire as well, so that you understand what income streams you have coming into you. Now, as we go into the last segment, which is taking a look at health and long-term care, the effects, the advantages, the disadvantages, etc., is understanding a few things. The first thing is financial security. All right, so that ensures that medical expenses and long-term care costs are covered or can be covered, reducing the risk of financial strain during retirement on any private savings that you may have. It provides you with peace of mind, knowing that unexpected health issues will not deplete your retirement savings. All right, having health insurance and a plan for long-term care facilitates access to quality medical care, long-term care services, whether that's nursing home, whether that's having a nurse at home, whether that is emergency medical treatment, and ensuring that timely and appropriate treatments can be accessed. Enhances the overall health outcomes by allowing for preventative care and early intervention. Asset protection. You want to take a look to make sure that your assets can be protected from being exhausted by high medical expenses and long-term care costs if they do arise. This also helps to maintain the standard of living and preserves inheritance for heirs or for beneficiaries or for spouses or for children, grandchildren, etc. We want to also understand how it can be seen as a tax advantage. So if you have savings and you have health insurance, those things are not taxed as you utilize your healthcare plans. All right, so making sure that you have health insurance or access to long-term care before retirement can be less expensive than trying to apply or trying to purchase them later in life. Insurance premiums are generally lower for younger and healthier individuals as well. It provides coverage for a wide range of medical services, including hospital stays, including doctor's visits, including prescription drugs, and preventative care. Whereas now long-term care, having a long-term care plan covers things like, whether you have in-home care, assisted living expenses, nursing home care, which are generally not covered by standard health insurance. And obviously the peace of mind in knowing that there's a financial plan in place for health-related expenses, which reduces or can reduce anxiety about the future. It allows the retiree to focus on their retirement without worrying about potential health crises. Now, you may see this as a disadvantage, but generally, the older individuals are, costs can be especially more expensive and particularly more difficult or complex to apply for or to get. All right? There are certain things like exclusions and waiting periods and various levels of coverage, etc., that may have to be navigated in order for it to be approved. All right, there's availability and the qualification factor. So some individuals may face difficulties qualifying for certain types of plans due to pre-existing conditions or due to age. And then there are things like changing needs. So the healthcare needs and financial situations can change over time, making it potentially less suitable for elderly individuals. So overall, it will be necessary to periodically review and adjust as time goes on. And like I would have mentioned in episode 1, every intentional step gets you closer to your goal. All right, this is your retirement we're referring to. This is your long-term plan we're talking about. This is your retirement journey. It is for your advantage. Yeah, we want to understand what your goal is. What is your end goal? What is it that you're looking to achieve in retirement? And when you plant that seed today, it is to provide shade for the long-term future. Yeah. So just to be able to recap as we come to the end of our presentation today, Compound interest works like growing a tree, all right, where you're consistent, you have the protection against risk, and your initial efforts multiply over time, resulting in a fruitful and resilient asset. By starting to invest early, you ensure you have enough fuel to drive a reliable vehicle, maintain your independence, and fully enjoy all of the scenic routes and growth opportunities along the way to your retirement destination. For young adults, like planting a seed, it requires time and it requires patience to grow a strong tree. For the middle-aged adults, pruning the tree to ensure it grows healthy and strong. And for our pre-retirement retirees, you want to enjoy the shade and the fruits from that tree, focusing on maintaining it. You want to identify the strategies that can be tailored to fit individual risk tolerances, investment goals, and retirement timelines, providing diverse options for generating cash flow during retirement. And remember, for Social Security, the eligible ages, the qualifying factors, keeping your details up to date, and accessing the online portal. And lastly, your health and long-term care. The cost can be significant in a very short period of time, and it's important for you to plan and be prepared. Now, at this time, I'd like to say thank you to all of you who participated, and I'd also like to encourage you to take steps towards the future seriously, not just for retirement, but for every tomorrow that comes. I've been seeing some questions coming in. You were an awesome virtual audience, and we would like now to hear your questions. So at this time, I will hand back over to Miss Sheila Grosette.
Thank you so very much, Gail. And we are at the question and answer segment of today's webinar presentation. And this is the time when we get to hear from you, the attendees. Now, in the first session, we would have had some questions in relation to Social Security. And just to emphasize then on that aspect of the presentation, there are some questions then that I will pose to Gail relating to Social Security first. So there was this question: how do you go about knowing your pension status at NAS to determine what work you need to do to attain comfortable retirement?
Awesome. So thank you so much for that question, Sheila. The benefit of having access to your online portal. I would have gotten access to my online portal at the National Insurance and Social Security Service a couple months ago, and having access to that portal, I was able to log in and play around with it a little. But initially, I would have found the estimation calculator, which shows me, or I'm able to calculate by the age of my retirement, what it is I would be looking to get from NAS as a pension. Now, as you can imagine, as a financial advisor and as a planner, it helped me to understand what I need to do as a buffer. And therefore, it helped me to understand what I need to do to be able to plan. How can I invest to make sure that my retirement will be comfortable? So I would encourage you, and to answer that question, is to get access to the online portal where you can actually calculate, based on the number of contributions that you will have by the time or the year of retirement, estimate your pension, right? Look at the dollar value and see what it is you need to do between now and retirement in order to build a buffer to make sure that you are still going to be earning enough to take care of your bills and live comfortably during retirement. I hope that answers the question.
Okay, thank you for that. And there was this other question in relation to the pension as available. What percentage of your salary becomes your pension when retired? I know you spoke to the ceiling, so perhaps we can repeat that information.
Right. That's another good question. So, for example, like I would have mentioned, the ceilings per week. If you're being paid weekly, your ceiling for insurable earnings for pension is $1,201, and similarly per month, your ceiling is $5,200. Now, and to answer the question, what percentage of your salary becomes your pension from Social Security would depend heavily on how many contributions you have and what are your best 5 years. Because what NAS does in order to calculate your pension is to take a look at the best 5 years earnings throughout your working years. So your best 5 years may not be your last 5 years before you retired. It could be year 20, it could be year 10, it could be year 24, and it could be year 32, and then year 38. They look at the best 5 years and calculate your pension off of those best 5 years to be able to make sure that you can maximize your pension from NAS. All right. Now, generally, depending on what the amount was for those contributions in the best 5 years, your pension could be calculated anywhere between 30% and 60% of the best 5 years. So on average, you may want to say, okay, well, my best 5 years, and divide that by about 40% or 45% in order to get an idea of what your pension will possibly look like if you were not reaching the ceiling, the maximum amount of $5,200 per the best 5 years, right? To find out what your pension will be from NAS so that you can plan accordingly. So I hope that answers the question.
Okay. There are some questions that came in relation to retirement plans or retirement funds. One of them is there such a thing as an ideal amount of money in a retirement fund?
So ideal amount of money in a retirement fund would depend heavily on an individual's financial obligations. What we say as a rule of thumb is to have at least 10 years worth of your financial obligations, your monthly financial obligations, put aside for retirement. Now, that is as a rule of thumb. That does not take into consideration factors like inflation and emergencies and healthcare and, should life happen, it just takes into consideration your monthly expenses. Now, it will vary from person to person because everybody may not have large monthly expenses like a mortgage or a vehicle loan, things of that nature. Some persons, they may have had to extend their large monthly obligations. They may still have debt. Unfortunately, there are certain things in life that may come up. They may have had unforeseen circumstances. They may have had a death in the family and had to borrow a loan later in life. There are things that come up from individual to individual. But to have an ideal amount, if you know you can have or have put aside 100,000 or 200,000 or 500,000, it is a start. It is better than having nothing at all. However, it differs from individual to individual. So there are certain things that you may want to sit and calculate on your own. Take a look at your monthly financial obligations, calculate it by 12 months, and then calculate that by 10 years and see what figure you are initially going to be working with. Of course, you would understand that NAS would take into consideration a portion of your income, but you would want to make sure that the full your full monthly expenses can, of course, be covered so that you are comfortable during retirement.
Okay, there was a second question as well in relation to pension plans. With regard to pension plans, the amount that companies want to give is very small at the time of maturity. To avoid giving the government the required amount, sometimes for $100,000, the company wants to give you $450 monthly until death. Not sure what happens to the remainder. The person wanted to know why is that in terms of the amount that you were given for the monthly amount that you're given for a pension plan.
Okay, so that it sounds to me similar to how an annuity may work, and that's because there are a couple of factors that have to be taken into consideration. So if you were to do the calculation and you take 100,000 and you divide that by 30 years, 30 years is the average time span for a retiree after age 65. It may come to less per month, or about $450 per month. However, $450 per month may be more in some cases than it may last longer than the 30 years. It may last that's supposed to be, if I'm understanding it correctly, your lifetime amount. All right. What happens after death? Sometimes it depends on the financial institution or the company that you're working with. The remainder can either be paid to a beneficiary for a certain amount of time, whether that's 5 years, 10 years, 15 years, 20 years, etc. But it's something that has to be set up from initiation of those payments or at the time of maturity. All right, I hope that answers the question. I am not certain exactly. Of course, financial institution to financial institution, it will differ, but I hope that that answers the question in part.
All right, there's this other question about health insurance. Can you explain the aspect of health insurance being taxed? How do you go about claiming that? Is a specific type of health insurance is eligible, for example, company group health plans or individual or family health plan? I guess which type of health insurance is taxed is the question that the person is asking.
Yeah, so health insurance here is typically not taxed, whether it is group health insurance or whether it is individual health insurance. What I explained earlier is non-taxable. So there's an advantage there where it is not something that is taxed. Depend whether it is your deductible, whether it is your claim, whether it is money coming back into you, whether it is your monthly premiums or your quarterly or annual premiums. Those items or those factors are not taxed. All right, so I hope that that answers that question or clarifies it anyway.
All right, we're just going to take two more questions because our time is rapidly coming to an end today. How do you avoid investment pitfalls?
That's a very deep question. There are times, depending on the type of investment, that investment pitfalls can be difficult, or I would say challenging. The pitfalls can be challenging to avoid. All right, so it depends heavily on company returns, company profits. It depends heavily on market conditions. It depends heavily on diversification. It depends heavily as well on performance of particular funds, depending on where and what those funds are invested into. It depends on guarantee periods. There's a whole load of factors that can influence whether or how significant a pitfall can be based on the investment tool or the investment strategy that an individual is investing in. So it's a deep question. Sometimes there are things that you can do to be able to avoid certain pitfalls, and that would be staying abreast of market conditions, being aware of the pitfalls that may be coming. There are certain things that can be avoided, etc. Especially sometimes in the real estate market, you can take a look to see, what's going to be happening with market conditions across the board with regards to real estate. I believe a lot of individuals would have or are now going the route of investing in a real estate, for example, for retirement income. So interest rates in terms of mortgages, depending on which financial institution you're looking at, the time frame as well for the mortgage and monthly paybacks, property taxes, insurance rates, things of that nature are what you would want to stay abreast on to make sure that your expenses with regards to real estate, for example, can be maintained by the rate that you may be charging in terms of your monthly rent. Because you will ultimately want to make sure that if you are going into real estate as an investment for retirement income as one stream, that it is something that you're doing to make a profit and not just as, you know, the property paying for itself by ways of rental income. The tenants are there to stay. They're going to be there for long term. The property is being maintained, things of that nature. So those are things that can ultimately be researched, and you can keep abreast of, you know, certain factors from year to year as things may change. You may want to shop around for better rates as it relates to insurance. Maybe there are certain things that, you know, you can do to be able to stay ahead of the game as it relates to the pitfalls. But it depends heavily on the investment tools and strategies that you're looking at and the risk tolerance that you would have mentioned before as well.
Okay, and our final question for today's presentation will be, what is the difference between the death benefit and a funeral grant?
The difference between the death benefit and the funeral grant. So the funeral grant would be a one-time payment, whereas the death benefit may come to an individual as a form of pension, which will be calculated similar to the survivor's pension. All right. Again, in both categories, there are qualifying factors where an individual would have had to have been contributing towards contributing towards NAS in order to be eligible for both the survivor's pension as well as for the death benefit. All right, the survivor's pension obviously would be for a case of a spouse, whereas the death benefit may come in the case where there is no spouse, but they may be child. There may be a child or dependent who may have been depending on that individual, whether that's a parent or a grandparent, and they're a minor. All right, so there are qualifying factors for both of them. Obviously, the death benefit figure is and would be calculated differently from the grant, because the grant is a one-time payment at a specific amount, which is right now at $2,250.
Okay, thank you, Gail. So we've come to the end of the webinar presentation for today. Gail, thank you so very much for sharing your vast knowledge on social security, health insurance, and long-term care with us. It was a pleasure interacting with you, and I look forward to our session next week. Thank you very much as well to my co-host, Ms. Fayan Jordan. Your assistance was greatly appreciated. And to you, the attendees, I thank you very much for your questions and contributions. I know we weren't able to answer all of the questions that you would have posted, but I've taken note of them, and those that were unanswered will be forwarded to the facilitator, and her responses will be shared with you via email. We will also be sharing the information provided by our presenter on the National Insurance and Social Security System via email. Now, the link to our evaluation form is going to be placed in the chat. So please remain in the session for a few minutes more to access the link and complete our evaluation form. Thank you in advance for your feedback, which is of great value to us as we plan future webinars. Also to be placed in the chat is the link to register for the third and final session in this webinar series on retirement planning. And that third and final session is scheduled for next Thursday, July 11th, right here on Zoom. And our focus next Thursday will be estate planning. So thank you very much again for taking the time to join us today. On behalf of the Learning and Development Directorate, I extend best wishes to everyone for a pleasant and productive remainder of your day. Some persons were asking in the chat as well in terms of the recording for today's session. Yes, the session was recorded, and an email blast will come and alert you as to when you can go on YouTube and view the recording of today's session. So as was said before, we'll keep the session open for a few more minutes to allow for the completion of the evaluation form and for you to access the registration link for next week's third and final session on retirement planning. Thank you.